Hi, I'm Dave,
And I'm Paul.
and we're going to challenge you to transform your financial future through the principles of the most profitable business in the world, banking.
We believe everyone should be involved in two businesses, the business that you're in and the banking business. Everyday people can replicate what bankers have been doing for centuries to leverage capital and build wealth through private lending.
Join us as we uncover the truths about money, expose lies and myths, and flip conventional financial advice on its head. Here we go. All right, Paul, welcome back. How was your week?
Oh, gosh. Yeah, pretty busy, but good. We got our wine fridge delivered today, so that's pretty cool.
You also had another delivery I saw, a new car, right?
Yeah, we did. Yeah, the CUDA showed up on Tuesday.
Now, what's up with that picture? There was a blue and a yellow one in that picture. Were they both
The blue
Cudas?
one is Tammy's father's 69 Camaro SS 396,
Okay.
4-speed, like real nice car.
Yeah. Nice. Have you been out to drive it yet?
No, they've
No?
driven it. So
Wow.
I'm taking Anthony down to Florida in March. We're going to go to a Red Sox spring training game, and we're going to go to a car show with the car.
Okay.
Because that's going to be his someday.
So when you do car shows, do you have to pay to have your car in there, or do they pay you to have your car, or is it just volunteer or what?
No, normally it's just like a lot of them are just like a community event where people
Okay.
just some are official, some are unofficial, where people just get together every Sunday or every Monday or Tuesday night at the
Yeah.
outside Applebee's or whatever it is in
Yeah.
Florida. So
And
I'm like the youngest
a bunch
dude
of
there.
old guys. Yeah.
it is right. I'm the youngest guy there by far. They're all old enough to be my grandfather,
Right.
or I guess father, because I'm getting old now. But
Yeah, you're not
so
that
yeah,
young, kid.
it's cool. And I got a car that I kind of always wanted as a kid, an old Mopar, and now I got one. So I have a new Mopar and I have an old one. So
Yep.
I'm good.
Nice.
Go.
Cool, man. I spent about 30 minutes today shoveling more snow. Just when I get the driveway cleared, I get hit with another like 3, 4, 5 inches, and I got to go shovel again. So irritating, but man, I'm so ready for this dark, cold winter to be over.
Yeah. At some point we need to move you out of there, and
We
move
will.
you to yeah.
We will. Once the last one's out of high school, or at least my youngest son, then we'll be left with 2 little girls. They won't quite be. Yeah, they'll probably be just entering high school. So maybe we can move them before that. Yeah, we'll see. That'd be nice. Reserve me a plot next to your dream home, and I'll build next to you.
Yeah. I'm trying to do that. So I'll let you know.
Yeah. Cool. Well, hey, last episode we talked about, I think we decided on that episode, we need to start doing like monthly live calls and give people an opportunity just to chat with us live, ask questions, anything like that. So we nailed down a date, February 16th from 7 p.m. to 8 p.m. Central Time. So February 16th, mark your calendars. There will be a link in the show notes where you can register for that. And we haven't quite decided on the format. We'll probably do an intro, maybe a little presentation for 10 or 15 minutes, and really open it up to a Q&A. I think that's our favorite part, is answering questions, right?
Yes, for sure.
So,
Interaction. Good.
yep. So tell your friends if you've been listening but you haven't like pulled the trigger, or maybe you have, you're a current client. But you just want to get in there with a chance to throw questions and listen to everybody else's questions and even answer some questions. I love having clients on those calls where they can attest firsthand to the power of infinite banking and what it's done for them and how it's changed their paradigm.
That's right. And we get those notes occasionally, don't we, Dave, from current clients?
Oh yeah, yeah, those are fun. Those are a lot of fun.
A lot different once when you go from conceptual to actual, execution of IBC in your life. Totally different.
Right, completely different. So don't feel like just because you haven't started that you need to know everything to get started. Like there's nothing in life where you can know everything before you start doing it. So,
right.
And this is just another one of those things. Once you start doing it, your mind starts seeing different things, and you start asking different questions.
Right on.
Yeah. Well, all right, man. Well, I figured, why don't we talk today? Because I have this conversation every time we get to the end of the process, when somebody gets approved for a policy, that's when we pull out the illustration, right? It's almost never do we pull it out before that piece has been completed. Like, hey, you're approved for life insurance. Now we're not wasting each other's time by designing an illustration and tweaking it to fit your goals and your life, because we know you're insurable. So we get to that part, and I like to show the breakdown and where all the money, all the premium is going into the different parts of the policy. But then we get to the actual illustration portion, right? Like, let's see the numbers. It's like the big reveal, right? But there's two ledgers. There's a guaranteed and then there's a non-guaranteed. So we wanted to talk about what's the difference between the guaranteed cash value and the non-guaranteed, and why we focus on one or the other. So Paul, if I pulled that up and I said, hey, Paul, what's the difference between guaranteed and non-guaranteed? What would you say?
I would say one is guaranteed.
Okay, good one.
No.
Nice dad joke.
I would say that probably, but no. So, Dave, it's a good question, and I think it's a legitimate question from new clients. It's good to know. Yes, I think they can differentiate between the meanings of those words, but these life insurance contracts, folks, have a guaranteed aspect to it where it's contractually guaranteed that year after year, this is the premium, this is the cash value. They represent end of year values if you're familiar with what one of these ledgers looks like, and then there's an end of year death benefit, right? And those are guaranteed by the company. So once that premium's been paid for a given year, the end of year value will be X. So there's that just guaranteed growth component. So it's not like the life insurance policies I used to have. I had regular vanilla non-participating whole life where I had a fixed premium of whatever and a fixed death benefit. So if my death benefit was a $250,000 whole life policy, it stayed there from when I bought it at age 23 to age 100 when it would have endowed and paid out.
Right.
Now they endow, of course, at age 121. So, but oh my God,
turn your phone off.
Turn my phone off. It's on.
It's Bush League.
Folks, this is
Is this your first
raw,
podcast?
Right? This is my first podcast. This is totally raw, and I think she gets that was Tammy, so she gets special privileges.
Oh yeah, you can put do not disturb, but your wife can get through that if you program them to.
Yeah, maybe she's programmed to get through. So anyway,
she probably did.
But I think I caught everything. I think I was done with that thought.
Okay. So let me elaborate then. So the guaranteed, let's talk, in like military terms or Army specifically, like guaranteed would be your most dangerous course of action. What does that mean? It means no matter what happens at the company, they could lose money that year and you're still guaranteed that cash value that they stated and that death benefit if you've paid your premium.
Yes.
Okay.
I like that.
Yeah.
I like that most dangerous course of action. I think a lot of people will understand that.
Right. So, let's talk about non-guaranteed. And if we were going to call this, what type of course of action would we call this?
This would be the most likely.
Boom. Yeah. I feel like I'm
in
some kind of a leadership course with the Army. Down at NTC prepping for.
Well, I think you talk about it like the Joint Firepower course in Las Vegas. That's an Air Force course that I got to go to at Nellis. Yeah. That was nice.
Yeah. What if we were there at the same time?
I was there July of 06.
I was there, after that. I was in Korea in July of 06.
Yeah, and there was a Lieutenant Colonel Toldy. He was a Southwest guy, but he was an A-10 guy in the
hog driver. Nice.
Yep. Cool. Anyway, great course. Really enjoyed it. And I won $50 at Treasure Island. So good.
It's a win all around.
Yeah. So the most likely on the non-guaranteed side. So again, if you're familiar with the ledger, you have left side guaranteed, right side of the ledger, which is actually a bit longer, non-guaranteed. And what that assumes, Dave, is, with these participating whole life insurance policies or dividend paying whole life insurance policies from mutual life insurance carriers, they have a great history of paying a dividend. And as a review, folks, what is a dividend? Well, the IRS characterizes it as a return of excess premium. We've explained in other episodes how it is much, Dave Ramsey defines it like that too, but it's much more than that.
Yeah,
right?
they're not just paying you what you overpaid, as Dave Ramsey might say.
Right.
They're just giving you back what you overpaid, you idiots.
Yeah.
Yeah.
It's so much more than that. And anyone who owns these things and has a super mature policy especially can attest to that.
Oh, yeah.
The dividends will become quite large.
Far greater than your premium. So
they can become far greater than the actual premium. Absolutely. No question.
Yeah.
So with that dividend history, and companies have 118-year dividend history, 140-year dividend history, something over 100 years straight without missing it. So that takes you through World War I, the Great Depression, World War II.
Joe Biden.
You heard it here. You heard it here, folks.
Yep.
Yeah, we just like reached our debt ceiling again, right? 31.5 trillion or whatever the heck it is.
Don't worry about it. I'm sure they'll, the media will start covering something about Prince Harry to take your attention off of it.
Tammy said that was a good. She watched that Netflix thing. I'm like, why are you watching?
Oh, why would you watch that? I'd rather watch the Kardashians, but man, we're getting off topic quite a bit in this podcast. Yeah. So let's get back to the non-guaranteed. Anyway. Simply, non-guaranteed just means it includes dividends.
That's right. At the current scale, as the current company experience, Dave, right? Which will change.
Right. So if dividends this year were 5%, declared to be 5%, then the illustration would illustrate a 5% dividend from now until the day you die, all the way to age 121. Is that realistic? No, absolutely not. That's not going to be the same. But it's going to be a lot closer than the guaranteed side if past performance is any indication of future performance, which with life insurance companies, I firmly believe it is.
Yes, very stable business, using the law of large numbers, being conservative. Now, are all the life insurance companies built alike? No, not really. Some are bigger. Some take on a little bit more adverse selection, maybe because they can. Some have offerings, Dave, that I don't particularly like, or strategies that I don't particularly like. But that's all here and there. They all have a very good dividend history, and they all have a history of stability. So
right, the mutual ones, which have been around for a long time.
That's right. So, and the ones that have demutualized, they're pretty profitable too.
Yeah, right. So, and even more profitable now for stockholders.
Right.
So there's the guaranteed, non-guaranteed. We like to focus on, like, the guaranteed side is absolutely critical. Like, if you don't have guaranteeds taking you up to age 121, then it's not a permanent life insurance policy, in my opinion. They might classify, like, usually, IULs, universal life policies, they'll have a guarantee up until like age 65. And then the only guarantee they can give you is that you might be out of cash value. And if that happens, you're going to be out of death benefit too.
Cash account.
Okay.
That's right. They want to tell you it's a cash value, but it's not. Right. It's just a separate side account, right? It's not cash value because it's not tied to the death benefit, is it?
Crazy.
So, great product.
But great. We focus on the non-guaranteed side because that's more likely to happen. And frankly, I think a dividend rate of 5% is pretty historically low because interest rates have been historically low. Now interest rates are going up, which means the policy loan rate's going to go up, which in turn, again, if history is any indication, then dividend rates will continue to go up too, because that's just saying these insurance companies are getting a larger return on their investment now because money costs more now.
Yes, that's right. And, it won't be an instantaneous change for those of you who currently own policies. Could you see a higher dividend next year? Yeah, maybe.
Yeah.
Could it take 5 years? Yeah, maybe. I mean, who knows?
Right.
But in the end, like you said earlier before we went live, Dave, I only care that I get a dividend.
Yes.
That I'm participating in the profitability of this company.
That's very important. And the fact is, so if you look on the guaranteed side, that's the most dangerous course of action, right? That assumes no dividend is ever paid out for the rest of your life. After a couple years of that happening, I'm probably thinking about moving my policy somewhere else, or I'm probably not going to get more policies at that company
Right.
if they haven't paid out dividends for a couple of years. So you could expect if a company does that, they're going to go out of business because that just means they're not profitable.
Right.
So,
And they'll likely get scooped up by some hedge fund from wherever.
yeah.
Maybe.
So there you go. And that's why we focus on the non-guaranteed side. I think it's better for planning, for forecasting. And it's probably going to end up somewhere between the guaranteed and the non-guaranteed, but could also be greater than those numbers on the non-guaranteed side if dividend rates go up.
Yes, I would say this. I think the most likely, I just made that up, is somewhere in between, but close to what is assumed off that original illustration. I think it'd be somewhat close to that, relatively speaking, to premium paid and all that. Don't beat me up, agents. You know what I'm saying. But somewhere between the guaranteed and the non-guaranteed of your original illustration is probably the most likely. But like you said, if rates stay high for a long time, maybe it'll be higher. It just depends.
Right. So,
and honestly, Dave, I don't care.
And why don't you care?
Because I'm really focused on what's going on outside the policy.
Yeah.
I'm just using the policy to store cash and protect my family and create a legacy. That's it. And I have guaranteed death benefit right now. That is a lot, and that gives me that peace of mind. If the dividend is 5.2% versus 5.25% next year.
Yeah, let's not get tripped up in the details. I mean, we're arguing, we're splitting hairs at that point. Hey, that so-and-so company is offering 5.7. Your company, that you're talking about is only 5.2. Why would I go with that? Again, people, the dividend rate is only one piece of the total equation to determine how much cash value increase you actually get every year. It's just one piece of the equation. So don't get wrapped up in it.
Yep. And we've talked about that in another podcast today, where the rate that a company the gross dividend rate that a certain company may advertise, that is not what your policy is receiving.
Yep.
Okay.
Right.
Right.
Cool. Well, I think we hit that pretty good. So now that being said, what I will say is the non-guaranteed ledger gets taken advantage of by many, what I would call bush league agents out there who lead with an illustration. If somebody leads with an illustration, you can be sure the only thing they're going to point out to you on that entire illustration is the non-guaranteed side. Hey, this includes the dividends, and we're estimating dividends of 8% in the future.
Yeah.
Not like historically. They might have a historic one, but if they focus on the one all the way to the very, very, very right of that page, which is going to be likely, in the ones I've seen, like IULs or something, that's always the highest projected return. That's where they're going to focus your attention. So don't bite on that, and don't take that as gospel, because you can bet. And people, like, I just talked to somebody today. She's a 52-year-old woman. She called me today. She came in through the podcast. And we were talking about her situation. She wants to insure her kids. And I said, well, okay, great. Do you have insurance? Yeah, I have a term policy. And I've also got this universal life policy that I purchased 20 years ago. And I just looked at it, and it has $6,000 of cash value. When I bought it, they said the cash value would keep going up every single year, and it was supposed to look a lot better. And I just groaned. It's the same old story you hear over and over and over from people in their 50s and 60s who bought these things 20 years ago. Same old story. So I've never met somebody, I'm sure there's some out there, right, who are like, hey, this was actually a good buy for me, and I have a great cash account, and it's not being eaten up by my ever increasing premium as I get older. Maybe there's somebody out there. If you're out there and you have that, let us know. I'd like to see it. I've just never met anybody or talked to anybody. It's always been the reverse.
Yeah, I think a lot of people, Dave, just haven't reached that point. I mean, she's 52. She bought it when she was 32.
She's lucky to have looked at it and paid attention to it right now.
Right. And she's not that old yet.
Not at all.
You know what I mean? So that premium, the way I've explained it to people that have had the IUL conversation with, I say, listen, look at this Look at this annually renewing term. The term ends when you're, let's say, 55. Look for the same death benefit at age 56. Look what that costs versus what it was costing you on that level term that you bought when you were, 20 something.
Yeah.
It is dramatically different, folks. And like our friend says, nobody's writing that check.
No, I just ran a term illustration today for a 10-year term. And then guess what? Year 11, when the guy turns 63, the monthly premium jumps from like $300 to $4,000.
$4,000.
The next year, it's like $8,000 per month.
Nobody's writing that.
Nobody's writing that check. Guaranteed. Even if you had the money, you would have better sense than to write that check.
So I tell people this, man. I don't know. Everyone's, and again, this is I'm painting with a broad brush, but I do know the universal life product and how it's built and how it's designed. I've studied it at length. I almost tell people, listen, if you're not going to do IBC with dividend paying whole life from a reputable company, and you're thinking about an IUL or some other universal, any of them, it doesn't matter. I think you'd be better off listening to Dave Ramsey and just buying a 30-year level term and investing the difference. At least you know what you got.
Yeah. Right. In either, I tell people term policy, consider any premium you pay as sunk cost, because it is. You're not getting that money back.
You're never going to see it again. Right.
I would consider IUL a sunk cost personally.
No question.
So, especially the longer you pay it, especially.
It's just, it's just not good. Anyway,
it's unfortunate.
And that question came in also through the email, through the podcast today, Dave, from a gentleman that asked. He says he owns 2 IULs and wants to do infinite banking, and it's kind of unclear to us. Does he want to use those for infinite banking, or does he want to change them out? We don't know yet. I have a phone call with this gentleman tomorrow, actually. But bottom line is, if he does listen to this episode, you cannot do IBC with an IUL. I don't care what all these YouTubers say and all these people that are quote doing it. Not an appropriate product for IBC.
No, it's not.
At least according to the man who discovered it, for whatever that's worth.
Yeah.
To me, it's worth everything. So
we did an entire episode on that. So if you want to dig more into that, go back and check that one out.
Yep.
All right. Well, before we finish, we mentioned death benefits. So I want to talk about death benefit a little bit. So IBC kind of, the one thing that we do poorly is talk more about the death benefit. I think, life insurance, first and foremost, we're life insurance guys. So you need to have adequate death benefit for your family's needs. Should, God forbid, tragedy strike. Or you die at 90, it doesn't matter. At least then you get to recapture all the taxes you paid over your life. That's one way to think about it.
Yes.
That's possible, right? You could recapture all the taxes you paid over your life with
both,
enough death benefit.
And you and I, Dave, have old grandparents still, don't we?
Yeah, 90 in their 90s, still kicking.
Yeah.
Yeah.
I'm trying to imagine, and I think I've mentioned this before, but like, had IBC or had insurance been a thing and my grandfather sold it. He was a John Hancock guy for years, briefcase and driving his, Chrysler LeBaron around or whatever. And, around East Boston and Winthrop
knocking doors. What a rough, that's a rough business, dude.
That was one of the many jobs. He worked for Pure later. Anyway.
Yeah.
Had that been the mindset and, whole life insurance been purchased, there'd be a future windfall here coming in. If my parents, my dad, when I was in Florida a couple weeks ago, mentioned, well, life insurance really, the way we were taught, was just for when you had kids and then, you don't need it anymore. And of course, that's what they were told. Yeah. So it's like, okay, yeah, that makes sense. But they don't understand the banking quality of this product. I wish, gosh, if they had, man, it would be just so much better.
I kind of compare it to, but if you take that, so you take that with your number one asset, which is your life, your human life value.
Yep.
If you took that same mindset to a car, like you just bought that CUDA, that thing's like 40 years old or 50, almost 50.
It'd be 53 this year in April.
It'd be 53 years old. Dude.
Or March.
53 years old. Like it's already old enough. Like you don't need insurance on that anymore. What do you need insurance on that for? Or think about, like, let's say you become a billionaire and you've got I don't know how much you paid. I'm just going to make up a number, $100,000, right? I'm sure, I have no idea about these classic cars. I'm not a car guy. So you pay $100,000 for a classic car. And then but you're super wealthy, right? So you could lose that car and that $100,000 and it wouldn't really affect you. Does that mean you're going to stop having insurance on that car? That'd be kind of stupid.
Well, it depends. If I designed a policy for infinite
To
banking
self-insure?
to self-insure, like Nelson explains in the book, maybe just I'll have liability on it, of course, but for collision but yes, I get you. Your point is totally valid.
I mean, you're not going to buy a $250,000 Ferrari and insure it for $100,000. That would be insane, right?
Point well taken.
We do this we do this all the time with our own lives. Is like, I might be worth $7 million, but I only have $2 million of life insurance because that's all I think my family's going to need for the next 10 years after I die.
Yep.
Right?
You should have 14 million there, pal.
Yeah. And guess what? Your human life value, all human life value is what the insurance company determines to be your economic productivity for the rest of your life. Like from now until you die, like this is how much they think you're going to be able to make. Your working years, whatever.
Yes.
And guess what? As your income increases, so you go from 25 years old to 30 years old, ideally your income increased. And therefore, your human life value increased because it's a multiple of your income.
That's right. Time to buy another policy.
Time to get more. So I think that's one thing that we need to, IBC practitioners in general, of course, we do ensure people have adequate death benefit, but I personally am guilty of not encouraging people to maximize their human life value. And even if that's a convertible term rider that you carry for 20 or 30 years that you can convert over your lifetime, max out your human life value.
Yeah, no question. I think early on in my IBC agent career here that I did focus on mainly the cash value qualities, but more so as I've gotten more mature and more seasoned, the death benefit is, frankly, the death benefit is everything because you can't have cash value without the death benefit.
Right.
The larger the death benefit, the larger the cash value ultimately will be.
Exactly.
Since, the cash value is simply the present value of the death benefit.
Yep.
So, but no, you're right. It can't be ignored. It's a wonderful thing because it gives me peace of mind. Everyone will miss me or miss you or whoever, but the idea of everything's taken care of because millions of dollars of tax-free wealth just gets paid out in 30 days. That's peace of mind that you can't really put a price on.
You're right. So they'll miss us with a smile on their face. That's the way I like to think about it.
That's right.
They'll be crying on the inside, but boy, will they be enjoying the outside?
Yes.
How cool is that?
How could they not?
How could you not? Somebody just unloads millions of tax-free dollars on your lap and says, do whatever you want with it.
Especially if I'm 98 years old and, he died peacefully in his sleep. Or
they're all looking at their watches like, when is this guy going to go?
When is he going to go?
He's worth tens of millions in death benefit. Let's go, Paul.
Put him in the
gates are waiting, man.
Put him in the CUDA and close the garage door and just leave it running.
That's terrible. No, you just need to go on one final, burnout ride.
That's right.
And just get it up to 200 miles an hour. And Jesus, take the wheel. See you later.
Right. Take the wheel. Doesn't have power steering either, so it's gonna be.
Are you gonna get that installed? Because I heard that's brutal. And how about the brakes? Have the brakes?
No power brakes, no power steering. Just pure muscle car, man. There's an engine, a 4-speed transmission, and a rear end.
I imagine that's why they call it muscle cars, because you either got to have muscles to drive it, or you're gonna build muscles driving them.
They just thought back in the day that if the power steering pump's drawing a little bit of power off the engine, that could be going to my dad's 69.5 Ford Torino had no power steering, no power brakes.
Oh, you're like, it's sacrificing horsepower,
right?
So
and he
why would
ordered
we do
it? He ordered it like that.
Yeah,
he ordered it like that. So
that's funny.
Pretty funny.
Yeah.
But no power steering. I'll let you drive it whenever you make it down to Southwest Florida.
Is that where it's stored?
Yeah.
Okay. Yeah.
No, I won't. There's no car culture in Northern Virginia. There's a bunch of, these people.
Yeah, but think how many heads you would turn being the only guy up there with a muscle
That's
car.
true. I've seen exactly 0 1970 CUDAs up here.
Yeah. I remember driving around with Chad and his Audi, the Tony
RS7.
Stark, the Tony Stark car.
Yeah, I almost bought that.
Yeah, I know. But we would drive it. We drove it through Hudson, Wisconsin, like this really busy strip, with a bunch of restaurants and slow traffic. But it was summertime, open air, so all these restaurants had their doors open and windows.
Yeah.
And every head turned. At least every boy and every guy turned their head and checked it out, and they're all like, "Light it up, light it up!" Like they all know what that car is. So.
Yep, that was a pretty car. I really like that. The color was Nardo Gray. It was a really nice car.
Yeah, it was great. Yeah.
And it was tuned.
Yep. All right, man. Well, perfect timing.
Perfect.
So, all right, everybody. Hey, live Q&A with me and Paul, yours truly, February 16th, 7 to 8 p.m. Put it on your calendar. Check the link in the show notes. Register. And we'd love to see you all there. Until next time, control your capital.
Oh, man, we didn't rehearse
it up. All right. So, wait, you go, I go, you go, I go.
How about you go, and then I'll go?
All right. Should we just make that the standard?
Yeah, let's just make
From
it the
now on?
standard.
All right.
You go, and then I'll, because you're older, so you should go first.
Beauty before age, muchacho. Beauty and age before whatever you are. All right. Until next time, control your capital.
Or somebody else will.
Hey, thanks for listening, everybody. If you'd like to have a conversation with us to see how you can become your own banker, or if you have any questions or topics you'd like us to tackle on a future episode, please send us an email to davidandpaul@theibcguys.com.
And subscribe and leave us a review if you're on Apple. Follow and leave us a 5-star review if you're on Spotify. And please share this with your friends. We'll see you next week.